So for everybody that's listening in here, I just wanted to just say that I'm very honored to have this amazing person on today. His name is Dr. Michael Finke. He is not only somebody that I've reviewed a ton of content on when it comes to a lot of white papers that he's done and a lot of analytics that he's done, but also is very known in our industry for being an economist that talks about annuities. And so a little bit of background on Michael for those of you who don't know. He is a professor for the American College. He graduated from Ohio State University, and has just moved into the role of understanding a lot about income, nationally known researcher, and just has a lot of great insight. And how that all obviously wraps into annuities is fantastic. So Dr. Michael Finke, thank you for joining me. I appreciate you
It
coming.
is great to be here, and I hope you haven't oversold me.
Well, we'll see, I guess. No, and I've been following you for a while now. After some conversations with some other people that told me I should, and it's just amazing to me the perspective that somebody can have that is so far different than anything that somebody's seen from like a carrier, or you know what I mean, from the annuity standpoint. We're kind of in like this bubble, and if you can get outside of the bubble and talk to people that don't sell them, and just look at it from like this objective third party standpoint, it's really eye opening. And that's what I love, is that transparency. And so that's what I really am excited for to have you here.
Well, thank you, Tracy.
Yeah.
I have been, like a lot of economists, a fan of the idea of using income annuities for a long time. And just a little bit about my background. I was trained as an economist. I also got a PhD in finance. And I moved to Texas Tech University, which is a big CFP program. Most of the advisors there end up getting jobs for RIAs. Most of them are strict, fee only types of advisors. And I taught a PhD course in retirement income planning. I had to put it together back in 2007, 2008. And as part of that course, I would teach these PhD students how to think about retirement income planning. And in the economic literature, the idea of annuities being the most efficient way to generate income, if that's your goal, if your goal is income, then nothing does it more efficiently than an annuity. And at the time, I didn't think it was that controversial, but a lot of the students who had started out as RIAs and had decided to get their PhD, they were initially resistant. And in fact, there were faculty members that were trained as RIAs that were resistant to the ideas of annuities. And to me, that was an eye-opener. It was a bit of a shock. Why are they so resistant to this idea of buying annuities? And in fact, at that time, I met a researcher in Japan who was also doing work on retirement income planning. He was trained as an economist, and we both kind of thought the same way about this. And that was Wade Pfau. And so we started doing research together back in 2012. Also started doing research with a guy named David Blanchett, also who was working at an RIA and decided he ended up working at Morningstar, became the head of retirement research at Morningstar. But all of us really had this idea that if you're going to do it right in retirement, you've got to at least consider the use of an income annuity. It does things that investments can't do. And I'll tell you right now, I was just on a very famous RIA's website. It's a person who says that he hates annuities. And on his website, he says, annuities, I can do with investments anything that you can do with an annuity. And I read that and I think, no, that's wrong. There isn't a single economist who would agree with you that
Right.
you can do investments what you can do with an annuity. Now, that said, annuities, they span a range of different financial products. And hopefully we'll have a chance to talk about that today, some of which involve this economic concept of annuitization, either in the form of a lifetime income benefit or through true annuitization. Both of them, by the way, to an economist, they're kind of the same thing. A lifetime income benefit does involve taking advantage of the benefit of annuitization. However, it still offers a lot more optionality than a traditional fixed annuity.
Right.
Um, And you mentioned at the very beginning of this discussion that it was okay to go off track. That's the way my brain works. So
Yeah,
if we can go off track here for a moment, David
definitely.
Blanchett and I were just talking yesterday about some of the income guarantees on fixed annuities with an income benefit. And some of those income guarantees, they rival the amount of income that you can generate from a fully annuitized SPIA or
Right.
a deferred income annuity, a DIA. And what we're seeing in the market is really amazing choices for consumers who can't quite stomach this idea of illiquidity and can benefit from the annuities, the lifetime income protection that you get from an annuity. We're seeing products that are offering some incredibly generous income guarantees. So the bottom line is I started out thinking about annuities for that advisor audience, for the RIA audience. How do you start incorporating annuities into a retirement income plan? And that's still the way that I think. You're a comprehensive financial advisor. You're helping the client solve their goals, whether it's legacy or income in retirement, and then you're using a strategy that's going to do the best job of helping them solve their goals.
Right. And I think it's very important for people to understand that you do not sell annuities. You
No.
look at them objectively, right? And so that's something that I've tried to have that conversation with people who do not sell them, to have that, I do. That's how I make my living. I am a primary, if you want to call me a salesman, I will take that. I'd like to consider myself more than just a salesman, but I'll take it. But it's good to see how people look at them from the outside, and especially how economists look at them, like yourselves, right? Which kind of goes into our first topic of discussion, which is, how do economists in general, or specifically you, really look at annuities? There are so many different types out there, right? So we can go down a lot of different rabbit trails with how different types, but as a whole, how would you answer that?
Well, I begin by saying one of the most famous economists alive today is a guy named Richard Thaler. Recently won the Nobel Prize. He's considered one of the fathers of behavioral finance. He also has an interest in retirement income planning. And he wrote about 10 years ago an article for the New York Times called The Annuity Puzzle. And it's just a short article, but it's a very simple explanation of how economists think about annuities. And that is, when you don't know how long you're going to live in retirement, then you have two choices. You can be very conservative and not spend your money, be very cautious to make sure that you don't run out. Or you can partner with an institution who takes that risk off the table, the risk of not knowing how long you're going to live, and absorbs that risk. And it's a fair trade for both the individual and the company. Let me just give you an example. It's a story that I like to give about this value of transferring that risk to an institution. Imagine that your wife calls you up and says, it's your son's birthday. I'm not going to be able to be there. I'm working late tonight. There's going to be somewhere between 5 and 40 kids that are going to show up for the birthday party. And there's a cake in the refrigerator, and you need to decide how large of a slice to cut for each one of those kids as they walk through the door one at a time. So the first kid walks in, you've got the birthday cake on the counter, and you're thinking, all right, 35 kids might show up. If the 35th kid shows up and I don't have any cake left, they're going to be upset. They're going to tell their parents. The parents are going to get upset. I'm not going to get invited to any more neighborhood barbecues. So let's cut the cake into very small pieces, just to make sure that I don't run out. That's rational. I'm risk averse. I'm going to avoid the risk of potentially running out. So I'm going to cut a little tiny piece from my cake. And what if instead the bakery offers that they think on average about 20 kids are going to show up for a birthday party? The bakery offers that if you pay a little bit more for your birthday cake, and more than 20 kids show up, they will come with a second birthday cake. And what that allows you to do is to cut the birthday cake into exactly 20 pieces. Each kid gets a larger slice of cake, and you don't have to worry about running out. So everybody's better off when you transfer that risk to an institution of not knowing how big of a slice you should cut from your cake. Now, to an economist, it's efficient to transfer the risk of not knowing how long you're going to live to an institution, because otherwise from your savings, you would have to cut too small of a piece every year. So let's think in terms of income benefit. Let's like a 7% income benefit on $500,000 of savings. I can take $35,000 out of that $500,000 of savings every year. And I don't have to worry. I'm cutting a nice big slice from the $500,000 birthday cake, and I can do it every single year. And if I run out of money in the account, the insurance company steps in and continues to provide that income. So, but if I had that $500,000 and I had bonds, and bonds are paying maybe 5% interest, then I'm going to cut maybe $25,000 per year, maybe a little bit more. So I start eating into my principal a little bit, but I'm certainly not going to spend $35,000 per year. So essentially, I can spend more from the money that I've saved for retirement, and I worry less because I don't have to face this risk that I'm going to potentially run out. That is the value of an income benefit. You can get more out of your savings. That's why economists think it's a puzzle that more people don't buy an annuity when they retire. And in fact, it has the same as the annuity puzzle. And these days, economists spend a lot more time studying why people don't buy annuities than they spend studying. In fact, we proved mathematically that annuities were the most efficient way to generate retirement income back in the 1960s. So that's not even an argument anymore. The argument is, why don't people do it? And I think people don't do it because first of all, annuities, the name is polluted. And I blame a lot of insurance companies for abusive sales practices that have justifiably led to the demonization of the name annuities.
Definitely.
And I think and I've said this before, I think the insurance industry has the killer app for the rollover right now. And they polluted that killer app in advance of the biggest rollover in history, which is the baby boom generation. And the peak of the baby boom generation is 1957, 1958. They're just getting to be retirement age right now. That rollover stage, where people should be annuitizing a portion of their savings, insurance companies should be capturing 25, 30% of that rollover money. Instead, they're capturing less than 1%. And to some extent, I blame consumer knowledge. But I also blame, and that's the job of you as an advisor, is to be able to explain what this thing does and to explain it accurately. And again, that's also my problem sometimes with the way that agents explain the products, is that they go a little overboard, and you don't need to go overboard. You can explain what it does, and in an honest way, so that people don't get disappointed 2 years down the road and start complaining about you, and you don't get referrals and they're unhappy and the annuities get a bad name. That's how they get a bad name, because people have these expectations and the products don't meet up with the expectations.
Yeah, and I would call that conceptual selling. If you could sell, I mean, if you want to use the term sell, that's fine. But if you want to sell on the concept, or educate on the concept, and let that that prospect or consumer be able to ask the questions and provide education, then they can make an informed decision based on the concept. If you understand the concept of an annuity, then the details, although they still matter, they don't matter as much if you look at like a contractual guarantee. Hey, here's the concept, here's the guarantee. From there, X, Y, Z, A, B, C, right? And I think the biggest problem is you're exactly right. Agents try to oversell based on a lot of hypotheticals, which we're probably going to get into, and not the actual guarantees in which, or the concept of it, and that is a problem. And you mentioned something earlier, kind of comparing bond to annuity, and it's funny. I just posted this on one of my social media accounts. If you're a financial advisor, tell me a good reason as to why you're not offering annuities to your clients. And one of them had said that I can offer the same thing through whatever other avenue. And that's just not true. If you look at lifetime income, there's nothing out there that has a fixed lifetime income other than an annuity. Now, people want to talk about dividend portfolios. That's based on the amount you have inside of that investment. So your income fluctuates. You talk about bonds, but you have reinvestment risk with bonds, right? Yes, you can get that yield to maturity rate if you use, I think I've seen corporate bonds right now paying 6 or 7%, somewhere around there. Yes, you can get that yield to maturity, but it's simple interest, right? So it's not a compound, it's not a tax deferred, it's simple interest. And then on top of that, what happens after the 10 years? right? What are bonds going to be paying at that time, right? So you have this reinvestment risk that I don't think people really think about. What would you say if somebody said that annuities are more of a bond alternative? What would you say to that?
Oh, I say definitely. That's how you should view an annuity. Is let's talk about why that is the case, because the way I like to position annuities, and you can talk about index products with the withdrawal benefit as being very similar, and we'll talk about that later. But to me, essentially, they are a bond alternative. So I could hold my money in bonds. What is the purpose of bonds in retirement? The purpose of bonds is to fund less volatile spending. So retirees have a mix of spending categories that are more variable and more fixed. And about 65% of the average retiree's expenses are fixed. They can fund those with Social Security up to some extent, but if you're a higher earner, you're still going to have a significant gap of essential spending that you need to cover using less volatile investments. You can use bonds, and then the question becomes, all right, you're going to build a ladder of bonds. How long do you build it? And by the way, you said corporate bonds, 6 to 7%. I would suggest that you not use that yield spread between Treasury and corporates as a return. It's not a return.
Right.
It's a spread. And the
Right.
spread, historically, you only get to keep about a quarter of that spread because some of those companies are going to go out of business and not be able
Right.
to make those corporate bond payments in the future, depending on the risk of the bond. The corporate bond bankruptcies go up, obviously. So
Yep.
there is an ideal amount of risk that you should take with corporate bonds, and it's not super risky. A lot of people think that investing in bonds with maybe a 2 or 3% spread over treasuries is the way to go. But in fact, the farther you get away from treasuries, the less of that actual return that you capture. So
Right.
you cannot compare yields to actual returns that you're going to experience on your corporate bonds. I like using treasuries.
Okay.
Why? Because treasuries are a good baseline. You might get lucky and get what's known as a credit risk premium. So you might get a higher rate of return that you get from treasuries. But for most financial advisors, they're charging 1% AUM on that. So it's going to go away with the AUM in the best case scenario. So
Right.
let's just start with treasuries. And if you're going to do it with treasuries, at what point are you going to stop building that bond ladder? Age 90, age 95, age 100? Because if you stop at age 90 for a healthy female client, she's got a 50-50 chance of living beyond that. So essentially a 50% failure rate. That's not acceptable. So you build it maybe to age 95. Well, she's still got a 27% chance of outliving her bond ladder. You build it to 100. Well, she's still got a 9% chance of outliving her bond ladder. So if you build it to the age of 100, you're cutting the slice of the cake in very thin pieces, which
Right.
means that of the money that you have saved, you're going to spend less of it every year, and you still have to face this 9% risk of failure. Why not spend more every year? And essentially, annuities are priced as if they were a bond ladder up to the expected longevity, up to age 90. So you can spend more every year without the fear that you're potentially going to run out compared to a bond ladder. Now, one of the other benefits, non-qualified benefits of annuities over bonds is that during the accumulation stage, you don't have to pay tax on the growth within the annuity wrapper. Now, that may not seem that big of a deal, but the more growth you have and the higher the interest rates are, the more significant that becomes. And if you start doing head-to-head comparisons of non-qualified bonds to an annuity, I mean, it gets ridiculous after a while because it's not even a close horse race.
Yeah, and that's a great segue into really talking about what kind of advantages outside of income when it comes to taxes inside of an annuity. What are your thoughts on that?
So, well, first of all, let's lay out the good news and the bad news. Bad news is that equities housed within an annuity wrapper, especially if they are passive equities, and you get them taxed at ordinary income, then you lose all that tax advantage of holding assets within an annuity. Now, the most popular types of annuities with that are essentially wrapped investments are bond-like investments, and that can include index type of assets. So with an index type of assets, it is a very tax inefficient way of investing. So let's think about what an index type investment is. It is a combination of the insurance company's general account portfolio. So let's say these days the insurance company expects to earn 5% on their general account. You invest $100,000. The insurance company will put $95,000 into their general account. Then they'll put $5,000 into some sort of an option strategy with an upside. Option gains are very tax inefficient. So when you house them within the annuity wrapper, you get a distribution that is different than a bond distribution. And of course, the biggest difference is that you don't have the downside risk every year when you use that type of a strategy. And I'm getting a little bit ahead of myself again, because I think that's what we're going to talk about at the end of this. But let's talk about index investing.
Sure.
Because these types of investments are not that exotic. They're pretty simple. You know, there were the option mathematics were worked out in the early 1970s. There was a guy named Myron Scholes that in the 1980s did a lot of consulting for insurance companies. He had this idea, you know, wait a minute, you could actually put part of the money in the general account, part of the money in options, and you can create this distribution where you protect against the downside while preserving some upside. And if you read books on retirement there's a guy named William Sharp, founder of modern finance. He's got his own pet project, was a great textbook on retirement income planning. And Bill has thought about this a lot too. And he thinks that this is an idea that holds a lot of promise, because for a retiree, that loss equates to a decrease in their lifestyle. And so they might do whatever it takes to preserve their basic lifestyle, but then had the icing on the cake is the potential for upside. And so when you invest, you get the preservation of the downside, but you also get potential for some upside. And it is a very tax inefficient type of strategy. So in the accumulation stage, it's best to house this type of a strategy within an annuity structure. And then you get the growth, actuarially speaking. You should also get a higher income if you defer longer, which is why the income payout rates go up. It's the same thing as Social Security. Social Security has it all mapped out. You get 5% between 62 and 64, 6 2/3 between 64 and 67, and then at age 67 you get 8%. The same thing happens with annuities. Is, you know, every year your amount of income should go up every year. But if it doesn't, then there is actually an optimal year to begin taking your income. And maybe that's the late 60s. You're going to get a higher income if you defer longer, but actuarially speaking, you're actually losing money by doing so. Be great to have a little bit more research on this that I could share, but it's one of those ideas that I know, but I haven't actually done the research on it. I focus mainly on Social Security delayed claiming. But essentially, when you have a product like that, what you're doing is you're building up a greater income over time in a tax-deferred fashion. And again, it's not something that you need to oversell. You don't have to say it's just like investing in stocks, except there's no downside. It's not. You're only getting a small portion that's invested in a stock-like index. But that's okay, because that's a very inefficient, tax inefficient investment strategy, but it's one that's very appealing to a lot of people. It's housed within the annuity wrapper, which means that the growth is tax efficient. When you pull it out, the money is going to be taxed at ordinary income, but you're going to be in retirement. So the growth stage is when many people have a higher marginal income tax rate. The retirement stage is when they have a lower marginal income tax rate. So that deferral benefits from that uneven marginal tax rate. And it's I think, again, you know, don't oversell it. Recognize the value. You get lifetime income. You get a tax deferral benefit. But don't give people the expectation that they can beat a regular long only stock portfolio with this type of a strategy.
Yeah, and that's something that we see a lot, not only in the annuity space, but in the IUL space as well, which is like a whole different conversation to have, where, you know, you get a lot of these agents, and and I would say a lot of it is probably their fault, but a lot of it is on the insurance company as well, where they are getting their information from the carriers who are providing very, I guess, little clarification on a lot of the data they put out there, where it's hypothetical, it's back tested, it's this or that. And obviously we're talking about index products here, specifically, like fixed index annuities, where agents are seeing this marketing material that's showing, I mean, I don't know if it is still like this, but it was just a few months back. I could go in and illustrate certain carriers at 20+% averages inside of these products, and I could legally illustrate that and show that to a client with very little context. And that's just, who am I as an agent, if I'm new, or if maybe I'm not in the space, who am I to know that isn't capable of doing that, unless you actually go research how annuities are really designed, how long those indexes have actually been around, how these insurance companies hold their rates, historical versus back tested. There's a whole slew of it, and that's where you start to get into a little bit of the complicated side of it. And I was going to ask you, obviously we're talking a little bit about fixed index annuities here, indexed annuities, and we're talking about these guaranteed lifetime income riders that they have and how they're starting to become very competitive with a SPIA or a DIA. So lifetime income, where you're basically giving up your principal for a pension, almost like a personalized pension plan. I don't know if you're allowed to use that term, but it's very
Probably
similar, right?
not.
Yeah, probably not.
Having
But
dealt with enough compliance folks.
yeah. So, but it conceptually, you're creating this lifetime income stream, and you're basically, in a sense, giving a loan to an insurance company for basically an interest rate based on how long you're living for. That's kind of how we look at it. So
Right.
when you compare the two, what if you remove that lifetime income rider? Because we've seen portfolios that look at annuities as a buffer strategy, where, hey, let's remove some of the internal costs, right? Where maybe that income rider has a fee, maybe they're capping you on certain indexes that they wouldn't. There's a lot less expenses associated with it, and let's just look at it as a growth product, and I put that in quotations there. How do you feel about that type of a strategy, where somebody is just using it as almost like a buffer to their equities portfolio?
Yeah, so David Blanchett has written, I think more than anybody else, really good analysis on this topic. And let's take a step back and think about it as an economist. When you build an investment, a long only investment portfolio, you have a range of outcomes. You have a normal distribution of outcomes. And before you invest, you have to be willing to live with the consequence of any of those outcomes. Most of the outcomes are going to be around the average. Some of them are going to be at the tails. Sometimes you'll get really lucky and your investments will do great. Sometimes you'll get unlucky. And when we run a Monte Carlo analysis, we focus on those tails. How bad could it get? What percentage of outcomes is going to be at the tail? Would it not be better then to say, all right, I'm going to trade off one tail for the other. So I'm going to trade off the upside tail in order to get rid of the downside tail, because I just couldn't handle the consequences of the downside tail. And remember, everybody that is invested in, say, a target date fund today at retirement has to accept the distribution of whatever the asset allocation is within that target date fund. 2022 was a great reminder that, yes, if I pick up the wrong card at the beginning of retirement, then I have to live with the consequences. Right. And let's think about what those consequences are, because they're serious. I start out January 1st, 2022. I have $1 million. My friend also has $1 million. I retire January 1st. My advisor tells me I can spend $40,000 plus inflation every year, the 4% rule.
4% rule, yeah.
And then we get to November, and the second couple decides that they're going to retire. They had $1 million at the beginning of the year. Now they've only got $800,000 because the market's down 20%. And they go to see the same advisor, and the advisor says, oh, you can only spend $32,000 per year.
Right.
And they think, well, wait a minute, I haven't taken any money out of my investment account. My friend retired in January. You told them they could spend $40,000 a year. They're telling me I can only spend $32,000 a year. That's a big difference. Right. And that's the reality that we all face when we take investment risk, is that we have to be willing to cut back on our spending if the market doesn't do as well. Right. So let's think about ways to design a distribution using financial options that gives us a distribution that we can live with. And David Blanchett has found that actually for most risk-averse retirees, some type of a designed distribution, a structured distribution, is going to make them happier than just accepting that range of potential upside and downside outcomes. It's worth reading. It's very complex. Any sort of an option strategy is relatively complex. But I'm one of those who thinks, all right, if I could have more control over the range of outcomes, and what, a lot of people would say, well, I invest a higher percentage in bonds as a way of controlling that risk. Well, that did not work in 2022. Intermediate term bonds down maybe 10 to 15% over the course of 2022. You have to be willing to accept that. You can't just get rid of risk by investing in bonds. You have to accept the possibility that they could go down as well. So this is an opportunity to have greater control over that distribution. Now, first of all, I'm not confident that the illustrations are a good way of showing consumers what the trade-offs are of accepting a constrained distribution versus a long only type of investment strategy. I don't think they understand the expenses of it. I feel like there's this huge gap between, for the consumer, I can just go with stocks and bonds, target date fund, or I can do something different. But I want the consumer to have full information. I mean, that's the job of the informed advisor.
Absolutely.
Is to have full information about what the trade-offs are when they're suggesting a product solution. Because if the trade-offs are too great, then don't suggest it. But if it's giving them what they want, you have to first of all figure out what they want, and then you have to be able to show it to them in a realistic manner, an honest way. Then it's up to them to decide if that's something they can live with.
Absolutely. Yeah, I'm going to have to go. I have not seen that, and I have been following him, and I'll have to go take a look at that. And I think you hit it on the head. There's definitely different strategies that you can use with annuities that don't just involve like a lifetime income rider, or does involve it. I think it's really important to just understand that client makes that decision and that they understand the risk versus the reward. We've actually, it's hard when you sit down with somebody and you explain these lifetime income riders or SPIAs or DIAs to them, and how if positioned appropriately, actually gives the rest of their portfolio a lot more flexibility. Obviously, if you have a lot of your regular costs, you don't have to worry about like sequence of return risk with your other side of your portfolio. Hey, I don't have to take money out of there because I have it all covered here. That's kind of more of a maybe it's your vacation money, whatever. Okay, market's down, maybe you just don't take a big vacation that year, right? So you don't have to worry about digging yourself out of that big hole. But the important, or what we're seeing, is that when we explain these to somebody, I explain it in a way that, and maybe you can provide some insight here, where, listen, Mr. Jones, when you purchase an account like this, and you whether it's an income rider or if it's a SPIA or a DIA, I'm going to use income rider for a second. You really don't want to take anything more than what that income rider is going to give you. Okay. And obviously, if anybody out there's done enough research, understand that income rider and the income they're going to give you is not going to be offset by any type of growth in that product to make it to where you could do that. Those products really aren't designed to grow. They're really not. A lot of the costs are going into that insurance company not knowing when you're going to die, right? Longevity risk. They're taking on the risk so you don't have to. So if you took more than, let's say it was a 7% rider, you took 8 or 9 or the free withdrawal at 10%, what is that going to do to your income? So we look at it as, here's the guarantee. Here's what that insurance company is going to contractually guarantee you, as long as obviously they stay afloat, solvency ratio, TSR, all that stuff. Here's what you're going to get. Okay. Some consumers don't like that. If I have $1 million and I'm going to get 70 grand, I could have just put that in the bank for X amount of time, right? And I'm probably not going to live past that. What do you say to somebody who has that feeling that they're just getting their money back over a period of time, which in a sense they really are?
Yeah, I mean, that's where you have to focus on what your goal is. My goal is, and I would say begin the conversation with, how much do you want to pass on to others, and how much do you actually want to spend? So, and then you can focus on, with the amount of money where the goal is spending, how much could I spend if I tried to do it on my own? And then you start entering in this discussion about, well, how long do you think you're going to live? And most people really don't have a very realistic idea of how long they're going to live, especially
Right.
higher people with enough money to buy an annuity are going to live a long time.
Right.
Way to think about it, woman on average is going to live, healthy woman to the age of 90, a healthy man to the age of 88 on average. And there's, again, a normal distribution around that. And what happens when your money runs out and you don't have the income benefit and you're 90 years old? And what happens if you start getting low on your money? You've got the money you're going to pass on, and then you got the money you're going to spend, and you're doing great. You're spending money out of it, but then you're 85 and you start seeing that the account is getting smaller. You're going to get scared and you're going to spend even less. Is that risk that you really want to take on as a retiree, especially as an 85-year-old retiree? If
Right.
not, then let's transfer that risk to an insurance company.
Right.
But if you try to do it on your own, then that is always what's going to happen. Now, let's also have a conversation about this goal-based strategy, because I do think that everybody has in mind that they're just going to preserve their nest egg. That's not realistic for today's retiree that doesn't have any income other than Social Security.
Right.
If we look at the amount of income that you can generate from $1 million 50-50 portfolio of the S&P and 10-year treasuries, 10-year treasuries about 3.5%, S&P dividend yield about 1.7. So maybe that's 2.3, 2.4% income you're going to generate on a $1 million portfolio. That's not enough to live on. So
No.
you're going to have to start spending down your money. You're going to have to see those assets get smaller if the growth in that asset is not enough to counteract the amount of money that you're taking in income. And remember, growth is volatile. Where you
Right.
get a year 2022, you start out with $1 million, you take out, say, $40,000. Now you have $800,000 minus the $40,000 that you've taken out. You have $760,000 at the end of the year. All of a sudden, your perspective on how much you can safely spend has changed a lot over the course of a year. The income benefit allows you to say, well, that's too bad. I'm depleting my account, but I'm going to keep spending money. It's on the insurance company to cover it if I run out of money.
Right. Yeah. I mean, there's a lot of studies out there on the 4% rule and taking that into consideration. And I know a couple people that I follow on LinkedIn have done a lot of research and kind of comparisons of it. How do you feel as though the 4% rule, and this is kind of going off, topic here, how do you feel that aligns with, what an annuity does for somebody?
Well, the 4% rule, let's review what the 4% rule is. It is, if I have $1 million saved, I can withdraw $40,000 the first year plus inflation the
Yep.
second year. Inflation 8%, $43,200 the next year. Now, if you look at the historical data, back when the article was written in 1994 by Bill Bengen, that seemed like a pretty conservative way of looking at it, looking at historical US returns, looking at a 30-year time horizon. But in retrospect, we got really lucky in the United States in the 20th century in terms of stock and bond returns. So just looking at those historical returns, we had the Great Depression, but then we had a really amazing run up in the stock market in the 1940s and 1950s. So we got bailed out a few times. There's no guarantee you're going to get bailed out in the future. The other thing is that 30-year time horizon is no longer realistic for a healthy couple. There's almost a 50-50 chance that for a couple, one spouse, that if they start out with enough money, again, to buy an annuity, one spouse is going to live beyond the age of 95.
Right.
So the 4% rule in many ways ignores all those outcomes where you live a very long time. So a lot of people would say, well, why would I buy an annuity when I can safely get 4% plus inflation from an investment portfolio? And what Wade Pfau and David and I have been saying for a while is, wait a minute, given a realistic set of stock and bond returns going forward, bond returns have been far lower than the historical average recently. Stocks are still pretty expensive. The valuations are almost twice the historical average. There's no way that we can expect the same portfolio returns going forward as we could expect in the past. And if you start layering on realistic fees, like a 1% asset management fee, maybe a 30 or 40 basis point investment fee, which was not done in the original 4% rule article, all of a sudden that 4% rule, Morningstar estimated that it was now 3.2%.
Yeah.
it varies depending on expectations of stock and bond returns, but the reality is nobody knows. As interest rates go up, so does the safe withdrawal rate. But to what extent does it go up? None of us know in advance.
Right. And it's
It's no
based on your
guarantee.
portfolio value, right? So if your portfolio value goes down, does that mean that you have to actually reduce income even with inflation? Correct?
No, but
It does not.
that's one of the big fallacies of the 4% rule, is that you don't pay attention to what's happened to your investment portfolio over the last year. So
Mm,
that example I gave before, what happens if your portfolio goes down from 1 million to $800,000 by the end of the first year? The 4% rule says you just ignore it. But the
huh.
reality says that, oh, wait a minute, now my probability of success may have gone from 90% down to 60%.
Right.
That I can withdraw that same $40,000 plus inflation for the remainder of my retirement. I may not be willing to take that risk. So ideally, what I do is I cut my spending to bump my failure rate back down to a lower percentage that I can actually live with.
Right. And I mean, that really comes down to that whole sequence of returns risk that a lot of people don't plan for, or don't understand, even though it's a very simple concept. If you dig yourself a hole, you're going to need more to get yourself out of that hole just based on percentages. If you lose if
Right.
$100,000, you spend 20 grand, we go down 20 grand, you need more to get back just to even. And then we look at times like '08, where, portfolios lost 30 to 50%. I think a 30% loss is 46% to come back. 40% loss is 60 something to come back, and a 50% loss is 100% to come back. And I don't know about you, but I don't know very many portfolios that came back that quickly over a shorter period of time without somebody spending money. You start to spend money now,
Right.
especially your original amount you wanted. You're gonna run out of money really fast. Very simple. We see a lot of people that are really over positioned on the equity side. They don't have a lot of bonds, they don't have a lot of safety, they have a lot of stocks, they have a lot of ETFs, they have a lot of mutual funds. Maybe it's just the people we see. I'm not sure. And when you see that type of over position on equity, because of how it's done for them historically, it just makes you think about that 4%. What if you just took out 4%? What if you just took out 5%? Some people say 4% is not enough, 5% is not enough. I got $1 million, I should be able to take 50, 60 grand out of there and not run out of money. And then reality says, if you do that, you run a very high risk of really running out of money in a short period of time. So really comes back to, what guarantees you lifetime income. And there's nothing outside of an annuity that I know of. Do you?
No, I do want to reiterate that point about stocks. I wrote an article last year where it was titled "Forget What You Know About Stock Returns," where I look at the 20-year growth of stocks historically in the United States. And it really does seem in the United States, there were these two magical periods between the mid 1930s and the mid 1950s, where if you'd invested $1, it would have always grown to an amount greater than $7 over the next 20 years.
Wow.
Um, since 1988 or so, $1 has never grown to $7 over the next 20 years. So in other words, we had these magic periods where $1 never grew to an amount less than $7. On average, it was $13. But since
Wow.
the late 1980s, it's never grown to $7 over the next 20 years. And in fact, if you look at the 20-year horse race between different bond categories and stocks, you see that it's a pretty close race over 20 years. And if you're running a Monte Carlo and you're using those historical data where the stocks were absolutely trouncing bonds, then I think it gives you an unrealistic expectation of how reliable that, what we like to call the risk premium for investing in stocks, will be going forward. And the risk premium, if it really isn't that high, I feel like so many of our retirement dreams are based on this idea that if we just invest enough in stocks, they will always bail us out. But the reality is that they haven't really done that very well recently. And if we get unlucky, especially at the beginning of retirement, that can set us up for failure for the remainder of retirement. It can have a significant impact on how well I'm going to live every single year. And I hate to stake my client's lifestyle to the belief that stocks are going to provide that relief in the future that they've provided in the more distant past.
I think that that's insightful, and I agree. One last thing before we wrap this up that I want to ask you. Going back to kind of indexes, there are a lot of hypotheticals, a lot of back testing, a lot of not guarantees inside of some of these products. Where the industry is going with that, where do you see that type of stuff have it play its role out? Where do you see it going? And really, what do you think that regulators should do to maybe draw the reins in on that?
Well, if you think about what a product does, it's a set of rules, and you input volatile assets, and depending on what those rules are and those fees and those parameters, you end up with outcomes. And oftentimes in illustrations, it assumes that the input is fixed, and then you're going to get this return every year. This is what's going to happen in the future when we do a projection. But the reality is there's going to be a range of stuff that's going to go into the product, and what it spits out is going to be a function of these rules. That's why I think you need an illustration that provides this is what is a range of outcomes that could happen if you buy this product. This is what the range of outcomes will look like if you don't buy this product. This I want to have clarity, and I think that's what consumers don't have right now. Is they don't have clarity. And I think when they're getting the expectation that when I buy this product, this is what the illustration illustrates is what's going to happen. It's never going to happen. Unless it's a fixed product with not a whole lot of variability, you're going to end up with an outcome that's going to be different than what was illustrated. Could be higher, could be lower. But really what we're trying to do is get the consumers to understand realistically what they should expect. And I think one of the most important parts of explaining an illustration is you will never get this. You will either get something better or something worse. And this is based on a certain level of assumptions. And here are my beliefs about what the market is going to do, how the input is going to perform in the future. Maybe a more realistic expectation is that it's going to do something like this. But the alternative is this. And that requires a lot of knowledge, frankly, Tracy.
Right.
If I'm going to do it right with the illustrations I've got, essentially what I'm doing is I'm trying to interpret the illustrations in a realistic way for a consumer so that they have the right expectations about what the product is going to do. They should not have to do that. There should be a company that provides more realistic illustrations so that the consumer actually understands how this product strategy is going to perform different than doing nothing.
Absolutely. I couldn't have said it better. It's so challenging in the day and age that I live in, that we live in, because I do a lot of training. I train a lot of other advisors and agents and things like that. And it's hard to get it through somebody's head that just because it comes from an insurance company doesn't mean it's something you should show to a client. I mean, I even tell, we have a training platform and I train on there before I even show an illustration, because a lot of times we have to. So before I even show it, the client has already said yes, right? Have already said yes. I don't have to show an illustration other than the guarantee side of it. I've shown them the baseline. They understand the concept. Moving forward, let's talk about probably the will do, or the contractual guarantee to do, the might do, and then the probably won't do, but it's potential to do so. But really, we're already here. So anywhere from here, it's that you under promise, over deliver, right? That's, if we can stick to that in our industry and just being able to articulate the concept, I think this industry wouldn't have such a black eye. So anyways, with that, I really appreciate your time and coming on here. Such great insight from somebody who just knows an insane amount about these products and understanding income and retirement. It's very refreshing. So thank you. Thank you very much. I appreciate it.
Thank you so much for having me on. It was a great discussion.
Absolutely. All right. Well, thanks, Michael, and everybody watching. Feel free, if you'd like to reach out to us. If you have any questions, you can join our group on Facebook. And as always strive to be better. Have a great day.